The opening quarter of 2014 saw a fearsome winter affect much of the U.S., as well as the end to a year of recession for the Eurozone economy. Trouble in Eastern Europe featured prominently in the news over the quarter. Following the end of the Winter Olympics in Sochi, Russia invaded and annexed the Crimea, with economic sanctions following from a number of Western nations. At the end of March, about 40,000 Russian troops were massed on Ukraine's borders, and fears of continued aggression persisted. The bulls didn't quite trample the bears in the opening quarter of 2014. The S&P 500 fell in January, but advanced for the other 2 months. Still, the first quarter ended with the Dow in the red and only minor gains for the NASDAQ, S&P, and Russell 2000. Some fundamental economic indicators were unimpressive during the quarter, and analysts wondered if the winter weather was partly to blame. The Federal Reserve saw a change in leadership, with Janet Yellen replacing Ben Bernanke in January. Also, in keeping with their decision announced in December, the Fed began tapering down their QE asset purchases from $85 billion per month in December to $55 billion by the end of March. However, Janet Yellen acknowledged in March that the Fed's monetary stimulus is still needed and will be for some time. After a rough year in 2013, U.S. bonds saw a turnaround in the first quarter, with Barclays' aggregate bond index up slightly. Longer-term treasuries benefited the most, ending March up over 7% for the quarter. Commodities looked very good in the first part of 2014. Ethanol led the way with an advance of over 80%, with coffee and hog futures following with strong gains. The price of gold also rose for the quarter despite a drop in the month of March. Crude oil gained a little over 3%, while the U.S. dollar remained flat. Stock markets outside the U.S. saw a mixed quarter. Japan's Nikkei index dropped from 9%, while Italian, Indonesian, and Irish stocks all saw increases of 10% or more over the quarter. Following a volatile year in 2013, broad emerging markets saw a drop of about 1%. A number of other economic indicators from the quarter were mediocre. Unemployment ticked upward to 6.7% in February. However, the labor force participation rate also moved upward over the quarter to 63.2% from a multi-year low in December. The Institute of Supply Management saw consecutive increases for each month of the quarter in their manufacturing index, and headline inflation ran at about 1% for the 12 months ending February. The housing market saw a decline in existing home sales for the first 2 months of the year. However, in January, the S&P Case-Shiller Index, which tracks 20 metropolitan markets, saw a 13% increase in home prices year over year. Interest rates on home loans dropped slightly over the quarter. Fixed-rate mortgages of both the 15-year and 30-year maturities came down about 0.1% each to 3.4% and 4.4% by the end of March. At the start of 2014, analysts figured a plateau was ahead for the market this year. So far, stocks are doing little to prove them wrong. The S&P 500 can't gain nearly 30% every year, and already some analysts are worried about a bubble. However, April often proves to be a strong month for equities, and fundamental indicators seem acceptable right now. If the weather slowed the American economy in January and February, March and April indicators could surprise to the upside more than the bears think. Even if the upcoming earnings season is mediocre, stocks may have enough momentum to move slightly higher off of those improved indicators. If geopolitical developments don't cause Wall Street to think twice, spring could bring some nice gains and be much more encouraging for the investor. As always, we appreciate the trust you've put in your LifePlan advisory team and are grateful for the chance to serve you. If you should have any questions, please contact your relationship manager. Have a great spring.